Let's bring in Kevin Green, senior markets correspondent, to help take us through today's setup and get people prepared for the trading day ahead. It feels like there's going to be quite a bumpy road ahead today, especially given the context of what we finally got. We got the news after the closing bell yesterday, what these tariffs would be, this universal tariff across the board of 10%, but then more draconian tariffs against certain countries and places like China, European Union. So why don't we go through broad strokes for people and recap, kind of where we are, KG.
Yeah, so yesterday, obviously, the market was a little bit optimistic that this Washington Post report, if you will, stated that there was going to be a 10% tariffs across the board, right? And that the market was actually excited about that. We saw a little bit of a bid, but they only had half of the story. And unfortunately, when we actually got the news of the rollout here, as you kind of talked about, very aggressive tariffs on some of these countries that we trade a lot with. And I think the market's also trying to grapple with the fact that how these tariffs were actually calculated. They're basically looking at the trade deficit that we have between a country, just let's say China and ourselves. And they look at that trade deficit, and then they look at the amount of imports that China has for the United States. And they basically took the trade deficit, divided it by the imports, and then divided that by 2, and then that was the number for these tariffs here. And so when you're kind of looking at the rates for these tariffs, they're very aggressive. For China, as you kind of talked about, there was already some tariffs that were in place. There's an increase of 34% with the reciprocal tariffs. You add that to the 20%, you're sitting at around 54%. Now, if you also include the existing tariffs that have been in place for since the Biden administration and since Trump's first term, the blended average tariff for China right now is sitting at 65%. So that's very aggressive. We see the same thing across many countries here. And that's why we are seeing a sell-off. There's a concern about growth fears in the market. You are seeing the dollar move to the downside. And at one point this morning, Diane, the dollar moved so much that it went as low as what we saw back in 2015. That's how aggressive this move is in the currency market. So let's see how the market actually reacts when we open up here. It is an aggressive sell-off to the downside here. We are trying to hold this 55.20 level on the E-mini S&P futures. And let's see if some buyers try to step in here. But once again, it was it definitely caught the market by surprise, and it was not really priced in. Oh, and if you're looking at the VIX, VIX is only sitting at around 26.5 right now. That's actually very cheap compared to a 3.3% move in the S&P 500. So vol is actually relatively cheap compared to the realized move that we've seen overnight.
Okay, so let's talk about, look, the 10% did sound, that sounded like, that wouldn't be too much, but you're right, we only had some of the story here. Now, even the European Union tariffs, those are on the higher end of what was expected. What does all of this signal, especially like, for example, let's talk about tech, and, even they have the China exposure, Apple selling off hard, Nvidia selling off as well, although in some ways they may be somewhat insulated. But it seems like it's just sell first, ask questions later. What do we make of the patterns that we're seeing, especially in the tech sector?
Well, if you look at Apple, it's not only the fact that we have these tariffs that could slow consumer demand, right? And I think everybody kind of knows that. But Apple's also getting hit because they're probably the biggest target for China to retaliate against if they wanted to make some moves there. And then also from the EU or even the UK standpoint, they could also implement some technology taxes on software companies and some of these technology companies as well. So that's another fear that the market has, is not only just what's already in place, it's what could we see as far as a retaliation. We kind of talked about that yesterday morning as well. What if we do see a tit for tat and it starts to spiral a little bit out of control? I think that's where the market's really at right now. So that's why we're actually seeing this. It's not just consumer demand. It's also, could they be they have the biggest targets on their back as far as trying to impact policy here in the United States. And I think that's what the market's really kind of waiting for, if that's going to be the case.
Okay, that's a great point on if that's going to be the case. That seems to be the question. And there have been nations that have promised retaliatory action, although President Trump has characterized this as retaliatory tariffs. So it seems like we're going back into, hallmarks of the first Trump administration, where this was this tit for tat on tariffs. Let's talk a little bit about the impact to the retail sector. You're seeing some selling there as well. You've got shares of Nike under pressure, Lululemon under pressure, Deckers under pressure. Talk to us about the significance of this, KG.
Yeah, it's all about sourcing. So where do they actually manufacture their products or receive those products? And so if you're looking at China, for instance, Nike receives a fair amount of products from China and manufacturers in China. So these new tariffs are obviously going to eat into their profit margins, and then also they're going to have to raise prices most likely or eat those margins, and that could also slow demand. So they have once again a lot of exposure to this trade tariff battle. Decker's in the same light here. And I think even if you look at those that are kind of insulated, like a Lululemon, which doesn't have that much exposure when it comes to some of these cross-border production efforts, there's still a concern of an economic slowdown and consumer demand slowing down as well. And that could actually impact top-line growth here. So I think this is just it's a growth story. I think, once again, it took the market by surprise. I mean, Diane, I mean, we hit we hit two islands that don't even have humans there, that aren't even inhabited, that we hit them with 10% tariffs. So that's how aggressive this was, and that's why the market's reacting in the fashion that it is. I will be curious to see if we have this buy the dip mentality, though. I mean, we've seen that over the last couple of trading sessions. A 3% sell-off is really aggressive for us. And usually we don't end down 3%. Usually these days are either it's going to get a lot worse or we're going to claw back and try to cut some of these losses here. And I think that will actually be an interesting sign here for the market if we are able to buy this back. But technically, the trend is still intact for a downward move for the S&P 500 over the next couple of months.
Two islands without people on them. All right, then let's talk about then what your expectations are for where we could potentially land as it relates to the S&P 500. So we ended up with some buying yesterday. We ended up at 5670 for the S&P 500. What's your target we'll start out with the downside because, from the looks of things, we'll at least open lower, sharply lower. But then your potential target to the upside, what are those?
Yeah, so for the down, this is going to be a very wide range just based on the flows this morning. So this probably will change in the next hour or so. But for the downside, you're looking at around 5350, and then to the upside, 5650. So wide range. I'm expecting a lot of intraday volatility in this market here. A lot of news flow probably hitting the wire, and that'll actually impact us a little bit as well. And I think we're going to be kind of at a make or break. That 5,500 level on the S&P 500 has been tested before. We saw some buyers stepping in. We probably will, if we stay around this area, violate that level again. And that's going to be a key technical area for us to defend. And if we're unable to defend it, that's when you start looking at these lower levels and maybe even looking at the 5,000 level, over the next couple of weeks or months.
And KG, real quick, I just want to get a quick final thought from you. So far this year, for instance, you've seen some outperformance overseas. European equities had been outperforming the U.S. Right now, you are seeing pressure overseas. The FTSE's under pressure, DAX under pressure, the CAC 40 under pressure as well. Is this just going to be a kind of overall risk-off theme that we could potentially see today?
Yeah, we're seeing that for now. What I will say, though, don't keep your eye out on the equities, right? They tell you a lot. The currencies are really going to tell you a lot. And right now, with that dollar moving to the downside, that does not portray that we are in the driver's seat when it comes to this tariff policy. That portrays really weakness here in the United States. And you're seeing strength when you're looking at some of these other pairs. The Canadian dollar is gaining a lot of strength overnight. If you're looking at the Eurozone just in general, that's actually gaining a lot of strength here. And so those currency moves, those positive currency moves are actually going to be the indicator of who or where the market really kind of sees potential growth or at least relative outperformance for now.
Okay. All right. That's Kevin Green, Senior Markets Correspondent with the setup for today.